Uncover true value. Analyze deeper.
Two giant names in tech: Apple, ticker AAPL, and Nvidia, ticker NVDA.
That's right. We've got quite a collection here. Analyses, reports, technical guides, historical notes. It gives us a snapshot of these companies.
Yeah, and we're really honing in on their financials, technical health, history predictions, and importantly, the risks. Most of this reflects data and outlooks from, well, late 2024 and into May 2025.
Exactly. Think of this as your shortcut to being well-informed on where these two stand right now, according to this material we're looking at. We'll sift through the details, pull out the crucial bits.
And hopefully help you understand what the data suggests is most important for each. It's a fascinating comparison, really. You've got the established giant versus the hypergrowth engine.
Definitely. Where should we start?
Okay, let's start by diving into NVIDIA. First up, the company vitals. Who exactly is NVIDIA? Why are they so significant right now? And what are the core things they do?
So, NVIDIA. Founded back in 1993. The founders were Jensen Huang, Chris Malachowski, and Curtis Prime. They're based in Santa Clara, California. And Jensen Huang is still the CEO, which is pretty remarkable.
Still at the helm. And their business.
It's mainly split into two big segments: GPUs, those graphics processing units everyone talks about, and their Tegra processors.
And their significance. Why are they suddenly front and center for so many investors? What's the big deal?
Well, it really boils down to their leadership in AI GPUs. The sources highlight products like the H100 and especially their new Blackwell architecture as being absolutely key right now.
The hardware is impressive.
But it's not just the hardware. They've built this incredibly strong developer ecosystem around CUDA, their parallel computing platform. That combination, it gives them a dominant market share, especially in that crucial data center space.
Yes, CUDA. The sources spend a bit of time on the technical depth there. For someone who knows the term, but maybe not the nuts and bolts, what should we take away about that ecosystem? Why is it such a big competitive advantage?
It's deep, technically speaking. The sources point out that CUDA is much more than just code. It's a whole programming model for flexible parallel computation.
Okay, break that down a bit.
Think of it like this. Instead of tasks happening one after another, like standing in a single line, CUDA lets you smash a massive task into thousands, even millions, of tiny pieces that can all be processed at the same time, simultaneously.
Parallel processing, got it.
And it gives developers really sophisticated tools to coordinate all those little pieces, manage memory super efficiently, use features like cooperative groups to get sets of processing threads working together in complex ways.
Beyond just the basics.
Exactly. And even optimize how they submit work using things like CUD graphs. That level of deep technical control and optimization capability, it makes it incredibly powerful for these complex AI tasks.
And that ecosystem becomes sticky, right?
That's the key. It's a significant barrier for competitors because developers have poured so much time and effort into mastering it. It's a real moat.
Got it. So what they do is those powerful chips, GeForce for gamers, Quadro for workstations, and critically, those Tesla H200 and the new Blackwell GPUs for AI and data centers.
Right. And the markets are huge. AI, obviously gaming, automotive, think self-driving cars, and cloud computing. Plus, they're making strategic moves.
Like what?
Like launching a specific China-compliant AI chip in 2025, expanding their cloud offerings with something called DGX Cloud, and pushing R&D in areas like the metaverse and more AI.
Okay, that sets the stage. Now let's look at who's actually putting their money into NVDA, the institutional players. What do the sources tell us about the smart money here?
Well, the numbers vary slightly between sources, as they sometimes do, but overall institutional ownership is very high, somewhere in the 66% to maybe 74% range.
Wow, that's a huge chunk held by big firms.
It is. Over 7,200 institutional owners holding something like 18 billion shares, according to these 13F filings we have.
And the biggest holders, as of, say, early 2025.
The names won't surprise you. As of February 28, 2025, the sources list Vanguard Group with over 2 billion shares. BlackRock is right behind them with about 1.8 billion. Then FMR LLC, that's Fidelity, with around 1.17 billion, and State Street Corp with over 950 million shares. These are enormous positions.
Massive. And what about recent activity? Looking at Q1 2025, or maybe the last 6 months or so, what were the big players doing? Buying, selling?
The sources suggest pretty high institutional accumulation. They point to something called the Fintel Fund's sentiment score.
Okay, what does that score tell us?
Basically, it ranks stocks based on how aggressively institutions are buying or selling relative to their existing holdings. A high score means, on average, these sophisticated investors are significantly adding to their positions. Analysts often see that as bullish, because these firms have deep research capabilities.
So the score was high for Nvidia.
Yeah, suggesting net buying. And looking at specifics for Q1 2025, top buyers included Morgan Stanley and Goldman Sachs, both increasing their holdings. Vanguard also continued net buying.
But it wasn't all buying, was it? Surely some selling too.
No, not entirely. Some top sellers included BlackRock and State Street trimming their positions a bit, and there were some specific large sales mentioned from Q4 2024, like Legal and General Group and FMR LLC reducing their stakes quite significantly. But then on the other side, you see other large purchases. Barclays PLC made a huge percentage increase, XY Capital, Jones Financial also adding substantially, and Vanguard, Bank of America, and BlackRock added significant dollar values in Q4 2024 as well.
So weighing it all up.
While there's some trimming, yeah, the overall picture, especially looking at that sentiment score, points towards continued accumulation by institutions.
Okay, so the takeaway is robust institutional ownership. The giants are mostly holding steady, and that high accumulation score signals ongoing buying interest, even with some notable sales. It tells you the big money is generally leaning bullish here.
Seems like it. Now, shifting gears, let's look at the key technicals, what the charts are saying. The current price is around $135.13 as of May 30, 2025, based on one source we have here.
How does that stack up against the moving averages? Those usually give us clues about the trend, right?
They do. The sources list the 50-day simple moving average, the SMA, around $115, and the 200-day SMA is around $126.
So the price is above both.
Correct. Since the current price of $135 is above both, that's typically seen as a buy signal. Suggests a bullish trend is in place.
Go what? That sense of bud.
Well, one source does note a death cross formation happened back in April 2025. That's when the shorter-term 50-day average dropped below the longer-term 200-day. That's historically a bearish signal.
So which is it?
The thing is, recent price action has since pushed the stock back above both averages, so it's a bit of a mixed message from that specific perspective. The death cross happened, but the price recovered.
Mixed signals indeed. What about momentum indicators like RSI and MACD? Do they offer more clarity?
Somewhat. The 14-day relative strength index, or RSI, is noted at 66.64. That's technically neutral territory, but it is getting close to that overbought level, which is usually considered 70.
Okay, so maybe getting a bit stretched.
Potentially. Although another source has a conflicting lower RSI number, but the 66.64 reading seems to align better with the current price context we're seeing.
And the MACD. The moving average convergence divergence?
That's listed at 6.26. Now, this is interesting. It's actually generating a sell signal here, according to the sources.
Even though it's positive?
Yeah, because while the MACD line is above the signal line, the sources point to bearish divergence. Essentially, the price has been making higher highs, but the MACD indicator isn't confirming that strength. It's lagging behind. That can sometimes signal weakening momentum.
And another source had a different MACD reading.
Yeah, another source gives a bearish MACD of Nagasi 3.2. So again, some conflicting data points depending on the source or the exact calculation date, maybe. But that higher MACD reading showing divergence suggests the recent strong upward move might be losing some steam, at least in the short term.
Okay, and what are the key levels to watch? Support and resistance.
Support is identified down around $114.33, which was a recent low. And there's a critical support zone noted between $111.63 and $113.56.
And on the upside, resistance.
Resistance levels start pretty much immediately, around $135.34. Then looking higher, towards $140.35 to $141.09. And the all-time high resistance zone is cited around $148.64 to $150.04.
So summing up the chart insight for NVIDIA, what's the bottom line here?
Well, NVDA is clearly in a strong uptrend. It's trading above those key moving averages, which is definitely bullish. But you've got indicators like the RSI getting near overbought territory and that bearish MACD divergence. It suggests we should probably approach with some caution regarding potential short-term volatility or maybe a pullback.
So the trend is powerful, but the chart isn't necessarily signaling just smooth sailing straight up from here based on these metrics.
Exactly. There are some yellow flags waving, you could
Yeah.
say.
All right. Let's look at the price history and the drivers behind this, well, incredible run, the meteoric rise, really. The one-year return is listed around 56% as of May 2025, including a small dividend. But wait, one source mentions an extraordinary 11,118.69% gain from April 2024 to April 2025. That's a massive difference.
Yeah, that sounds like a calculation issue, or more likely, it reflects the impact of the 10-for-1 stock split.
Ah, the stock split. When was that?
That happened on June 7, 2024. So that huge percentage gain probably doesn't account for the split properly. The 56% figure is likely adjusted for the split or calculated from a later starting point.
Okay, that makes more sense.
Yeah.
Still, 56% is astounding growth.
Absolutely. And either number tells the story of genuinely incredible growth. Key events driving this have been things like beating earnings expectations consistently, like in Q1 2025, and the launch of that new China-compliant AI chip.
Looking back further, say 3 years, what kind of returns are we talking about?
Sources give figures around 300%, and another says 609.99% over 3 years. Again, potential differences in calculation methods or exact dates, but both show incredible strength. And it's tied directly to the explosion in AI and the demand for their GPUs.
Any key moments that propelled that 3-year run?
Definitely. The 2023 Blackwell architecture announcement was huge, and that massive surge in data center revenue we saw really pick off in 2024.
And 5 years. That must be pretty spectacular.
Around a 1,000% return, according to the sources. Phenomenal performance. Truly one of the market's absolute top performers, just crushing benchmarks.
What fueled that longer-term run?
Well, it started with their established GPU dominance in gaming, which was already strong, but then it got compounded by the massive, accelerating adoption of AI everywhere. Key inflection points here include the Ampere GPU launch back in 2020, their strategic pivot to really emphasize the metaverse and AI starting around 2022, and then the rollout of the H200 GPU in 2025, leading into this Blackwell excitement.
The historical price action just from, say, November 2024 to May 2025 shows that strong upward trend overall, right?
Yeah.
Hitting highs around $140 in November, then that all-time high near $153 in January 2025.
Correct. But there was a notable pullback in April 2025. The price hit lows around what would have been $300 pre-split. That was amid some trade concerns, and that's when that death cross formation happened too.
Before recovering to trade around $135 in May.
Exactly. So a powerful trend, yes, but with some sharp, though so far short-lived, bouts of volatility.
So the fundamental takeaway is crystal clear. Nvidia's incredible performance is just directly tied to its absolute leadership in AI and GPUs, and its consistent delivery of strong earnings results fueled by that seemingly insatiable demand.
That's the story the numbers tell.
So what do the experts on Wall Street think? Let's look at the analyst forecasts and readings for NVDA.
The consensus here is overwhelmingly positive. It's rated a strong buy. Looking back at October 2024 data, the breakdown was very heavily weighted to bullish views, something like 32 strong buy ratings, 12 buy, just 3 hold, and 0 sell or strong sell ratings.
Very skewed positive. And their price targets, where do they see it going?
The average target as of October 2024 was $165, that's post-split adjusted, with a range stretching from $120 on the low end up to $200 on the high end.
And more recently, as of May 2025.
The lowest stated target is still $120. Others are mentioning targets of $150 plus. And some analysts, like those at Rosenblatt and Tigris, reportedly have much higher targets, equivalent to around $200, $220 post-split.
Any notable recent changes in analyst sentiment that stand out in the sources? Upgrades, downgrades?
Well, Goldman Sachs reiterated their conviction buy rating back in October 2024 and raised their target. Citigroup upgraded to buy in August 2024, so continued bullishness there.
But not unanimous.
Not quite. It's worth noting that HSBC actually downgraded the stock to hold. They specifically raised questions about Nvidia's future GPU pricing power. Can they maintain those high prices long term?
Interesting point. So the key takeaway on analyst sentiment.
It's strongly bullish, no doubt. Analysts are really betting on that long-term AI potential. But you do see some acknowledging specific concerns, like that pricing power question from HSBC.
Which brings us neatly to looking ahead the future predictions. Let's explore the bull versus bear scenarios for Nvidia. What's the argument for the bullish case? Why could it keep going up?
The bullish scenario is really anchored in the expectation of, well, sustained, incredibly strong demand for AI accelerators. plus a successful smooth ramp-up of their new Blackwell platform, and crucially, enterprise and cloud companies continuing to pour capital into building out their data centers.
Makes sense. And the price targets they foresee in that bullish scenario.
Yeah.
The sources mentioned some numbers.
Yeah, one source mentioned a base case price target of $1,800 by November 2026. Now, that seems linked to a different reference price point than the $135 we discussed earlier, so let's maybe focus on the percentages. It implies a potential 50% increase from the reference point.
Okay, a significant jump.
And the optimistic case.
Even higher. That sees $2,200 by November 2026, an 83% potential increase. But that's contingent on Nvidia maintaining over 60% market share in data center GPUs and accelerating the delivery of those Blackwell chips even faster than expected.
Ambitious targets. What are the specific catalysts the bulls are watching closely in the next, say, 6 to 18 months? The Blackwell production ramp is absolutely key. Sources point to TSMC, their big manufacturing partner, potentially dedicating over half of its advanced 3-nanometer capacity just to Nvidia by Q3 2025. That could boost data center GPU revenue by maybe 60% year over year.
Wow. What else?
A surge in enterprise AI adoption. If Fortune 500 CFOs commit over, say, $5 billion in capital expenditures, that could potentially raise data center revenue by 70% in fiscal year 2026.
Okay.
Also, design wins and new automakers for self-driving tech could add maybe $2 billion in revenue. New AI services they offer, like Omniverse Cloud, could become a significant multi-billion-dollar annual recurring revenue business.
Any other potential boosts?
Yeah, even potential strategic M&A or joint ventures. Maybe a partnership with a major AI research lab. That could unlock totally new markets.
So the overall drivers boil down to continued AI momentum, huge data center spending, growing software monetization from things like CUA, and improving supply chains, allowing them to meet demand.
Exactly. And sources note that earlier concerns about maybe a slowdown or a digestion phase between product cycles seem to be less of a worry now. Why? Because demand for Blackwell looks really strong, and you have this rise of sovereign AI projects by different nations adding another layer of demand.
Okay, that's the bull case. Now, on the flip side, the bearish scenario, what drives that? Is it internal problems or external pressures?
It seems primarily driven by external pressures and risks, rather than fundamental issues with NVIDIA's core technology or execution, according to these sources.
What kind of price targets are the bears considering if things go wrong?
One source mentions a potential target as low as $100, specifically tied to supply chain risks becoming a major problem. Another mentions a price falling below $160, connecting it more to broader market sentiment trends, maybe similar downturns seen in other large tech stocks.
And what are the main risks driving that bearish outlook? You mentioned external pressures.
Yeah, these are the headwinds we really need to unpack now. They include geopolitics, rising competition, the potential for that massive AI spending to slow down eventually, valuation concerns, and operational risks.
Okay, let's dive into those risks and challenges more deeply then. The sources seem to spend a significant amount of time on these potential headwinds.
Yep.
Geopolitical risks and those U.S.-China tensions seem like a huge factor.
Absolutely huge. The sources repeatedly flagged this as a major, ongoing, and frankly, unpredictable risk. Nvidia is just deeply entangled in this U.S.-China tech rivalry.
How has it impacted them already?
Well, tightening U.S. export controls have already hit revenue. They've had to make costly adjustments, redesign products. It's a real headache. And crucially, these restrictions aren't just about lost sales today.
What's the longer-term impact?
They actively incentivize China to develop its own domestic alternatives. That could erode NVIDIA's long-term market access in China and actually foster competitors like Huawei who are pushing hard in AI chips. Plus, recent investigations by the U.S. House Select Committee just add another layer of uncertainty.
So it's not just dealing with the bans today, but potentially creating future competitors down the line.
Precisely. The sources emphasize that these China export bans are a primary concern. The restrictions limit chip exports, yes, but potentially even related networking products like high-speed interconnects. These are significant bearish factors and supply chain risks.
And it could get worse.
Yeah, further U.S. restrictions or maybe Chinese retaliatory measures are specific worries that could escalate things. And there's even a subtle risk mentioned that excessive or constantly shifting controls could cause customers outside China to maybe design out U.S. semiconductors entirely or push governments to favor competitors for national security supply chain reasons.
Okay, geopolitics is clearly number one. Competition is another growing threat they face, right?
Yes, definitely growing threats. From established players like AMD with their Instinct MI series accelerators and Intel pushing their Gaudi accelerators, they're trying to catch up.
But it's not just the traditional chip makers.
No. You also have the major cloud providers Google, Amazon, Microsoft developing their own custom silicon tailored for their specific workloads. And then there's the rise of more affordable, maybe specialized AI solutions, including from companies within China like DeepSeek. All of this could pressure Nvidia's market share and potentially their pricing power over the long run.
Makes sense. Is there a fear that the blistering pace of AI spending itself might eventually slow down or hit some kind of saturation point?
That's noted as a significant risk, yeah. Perhaps the biggest underlying fear that could undermine the whole bullish narrative. The concern is, will companies eventually pull back on capital expenditures? Or maybe enter a period of digestion where they focus on getting ROI from the chips they've already bought rather than just buying more and more?
What could trigger such a slowdown?
Could be a recession, obviously. Or maybe reaching a point of market saturation. Or even if AI models themselves become significantly more efficient and just require less raw compute power. The sustainability of these extraordinary growth rates, and whether companies will actually see sufficient return on investment from their massive AI spending, those are key questions raised in the sources. A slowdown in the pace of spending by the hyperscalers and large enterprises is listed as a primary risk.
And of course, with such a massive price run-up over the last few years, valuation concerns must be front and center.
They definitely are. The stock trades at very high multiples compared to its own historical levels. The sources mention a trailing 12 months PE ratio of around 65x, which is significantly above its 5-year average of about 45x.
What's the risk there?
It makes the stock particularly vulnerable to something called multiple compression. That means if growth rates decelerate even slightly, or if broader market sentiment just shifts away from growth stocks, the stock price could correct sharply, even if the company itself continues to grow respectably. The high valuation is consistently listed as a key risk, basically implying investors should be prepared for volatility and potential pullbacks.
Okay. Finally, execution and operational risks. It must be incredibly complex to manage the design, manufacturing, and rollout of these cutting-edge chips on such a massive scale.
Oh, absolutely. Managing profit margins during the complex ramp-up of a new product like Blackwell is a definite concern. Sources noted a recent dip in margins, though they called it transitional.
What else on the operational side?
They need to reinvest a huge amount of their free cash flow back into R&D and, critically, securing manufacturing capacity with partners like TSMC. Margin swings are possible if the average selling prices for their chips were to fall for any reason, maybe due to competition.
And the innovation pipeline itself.
Their whole strategy relies on rapid innovation, right?
Yeah.
That inherently carries risks like design delays, manufacturing yield issues with these cutting-edge process nodes like TSMC's 4N used for Blackwell, and even integration challenges for their customers trying to adopt the new tech.
So less reliance on key suppliers.
Exactly. Their heavy dependence on TSMC is itself a major supply chain risk. What if TSMC has problems? Other potential issues include margin pressure from high R&D costs and production expenses, potential pricing pressure from competitors we mentioned, and supply chain disruptions from geopolitics or even natural disasters.
And the complexity of the products.
That itself raises risks of, product defects, security vulnerabilities, maybe issues related to the massive data sets needed for AI training. It's a long list of potential operational hurdles.
So a pretty significant list of potential headwinds to balance against those powerful tailwinds. What about how management is seen in all this? Do the sources touch on management sentiment or market perception of leadership?
The sources offer somewhat limited specific detail on management sentiment itself, beyond just noting their effective execution so far.
But the analyst ratings suggest.
Well, based on that strong by analyst consensus, which seems to persist despite some recent target price reductions here and there, the market sentiment appears generally positive towards their ability to navigate this complex environment. The financial results, showing that substantial year-over-year growth, certainly demonstrate effective execution on their strategy.
So the market generally trusts management.
It seems so. Overall, the market appears to view management positively for steering the ship through this period of explosive growth. But the primary risks we just discussed, they're largely seen as external or structural to the market and industry rather than reflecting perceived failures in leadership or execution.
Okay, that gives us a really comprehensive picture of where NVIDIA stands right now. A story of incredible growth, clear technological dominance, but also facing significant complex risks. Now let's pivot. Let's talk about Apple, AAPL. A very different story, a different kind of profile in the tech landscape.
Right. A completely different beast in many ways. For Apple, let's start with the company vitals again. Incorporated way, way back on January 3, 1977. Founded by that legendary trio, Steve Jobs, Steve Wozniak, and Ronald Wayne.
Long history.
Very long. They've had multiple CEOs over the years, of course, with Tim Cook leading the company since 2011, and headquarters are still in Cupertino, California.
What are their core competitive advantages, the why for Apple? What makes them tick?
Apple's strength really comes from these pillars they've built over decades. First, their incredibly established ecosystem, iPhone, Mac, iPad, watch services. It all works together and kind of locks users in.
The walled garden effect.
Exactly. Then there's the fierce brand loyalty. People pay a premium for Apple products. They generate enormous amounts of cash flow. And increasingly, a huge part of the story is the significant growth in their services segment.
And their products and markets.
Yeah.
Pretty well known, I suppose.
Yeah, their main product lines are obviously the ubiquitous iPhone, Mac computers, iPad tablets, and their wearables category, things like the Apple Watch and AirPods. Their end markets are basically global consumer electronics, the enterprise market to some extent, and all of that is underpinned by that powerful services business.
Which includes?
The App Store, Apple Music, iCloud, Apple TV, plus Apple Care, lots more. It's a big and growing part of their revenue.
Now, one area the sources specifically highlight for Apple, which is interesting to see detailed in this kind of financial deep dive, is their strong focus on environmental and sustainability initiatives.
Yeah, that stood out. It's clearly a significant part of their corporate strategy and identity, according to this material. Not just greenwashing, it seems.
What are some of the specific details mentioned there? Sounds quite extensive.
It does. They have this really ambitious goal of eventually sourcing only recycled or renewable materials for all their products. In 2024, they reported that 24% of the materials and products shipped came from these sources already.
And specific targets.
Yeah, very specific goals for 2025. 100% recycled cobalt in all Apple-designed batteries, 100% recycled tin soldering and gold plating in their circuit boards, and 100% recycled rare earth elements in their magnets.
Wow, those are incredibly granular targets for a company this size.
They really are, and they're working towards using 100% clean electricity for their entire product value chain by 2030. They actually hit 100% renewable electricity for their own corporate operations way back in 2018.
That's impressive.
And since then, they've helped create almost 1,800 megawatts of renewable energy projects globally heavily weighted towards solar and wind. They even give an example, the Bonnie Brook Solar Project that supports their data center in Mesa, Arizona.
So they're investing in generation too.
Seems like it. They're also pushing energy efficiency and emissions reductions specifically within their supplier facilities, not just their own operations. And the big goal is achieving carbon neutrality for their entire fiscal year 2030 carbon footprint.
Anything else on the environmental front?
Yeah.
Zero waste.
Correct. Minimizing plastic in manufacturing is a stated focus. The sources say that since 2018, they've diverted 22,000 metric tons of plastic films from landfills and managed to reuse 33,000 metric tons of plastic trays. They're also working on developing safer chemistries, phasing out potentially harmful substances from their manufacturing processes. It's presented as a really comprehensive initiative.
Interesting. Okay, shifting back to the financials for a moment. The sources mention Apple's commercial paper program. What's that about?
Yes, this is basically how they manage some of their short-term funding needs. They issue unsecured short-term debt promissory notes, essentially for general corporate purposes.
Why?
Things like paying dividends to shareholders and funding their huge share repurchase programs. As of late September 2024, they had about $10 billion of this commercial paper outstanding, which was actually up from $6 billion the year before.
And the interest rate.
The weighted average interest rate on that debt was 5.00% in 2024, according to the source. It's a pretty common tool large, financially stable companies use to manage their day-to-day liquidity needs.
Gotcha. And employee incentives. Anything notable there?
The sources mention restricted stock units, or RSUs, as a primary form of employee compensation award under their incentive plans. It outlines pretty standard details, vesting terms, data privacy acknowledgments employees need to make, tax stuff upon settlement. Nothing too surprising, reflects fairly standard corporate compensation practices for tech companies.
Okay, that gives us the foundation for Apple. Now let's look at the institutional trades again. Where is the smart money moving here? Is it similar to Nvidia or different?
Well, institutional ownership is substantial, though actually slightly lower than Nvidia's percentage. Around 61.18% of Apple shares were held by institutions, according to one source. Vanguard and BlackRock remain core holders, of course, often because Apple is such a huge component of major market ETFs.
But there was a big change recently, wasn't there? With a very famous investor.
Yes, a really significant event highlighted in the sources was Warren Buffett's Berkshire Hathaway significantly reducing its massive stake in Apple during 2024. That was a major sell-off that definitely drew a lot of attention and commentary.
A big vote of, well, not confidence, maybe. And any other specific notable activity more recently, say in Q1 2025?
Yes, the sources point to, well, that massive sale by UBS, especially when combined with Berkshire Hathaway's earlier significant reduction, really does signal potential shifts in sentiment or maybe just strategy among some very major institutional players. While overall institutional ownership is still robust, these large divestments are significant data points. They suggest that some big institutions are perhaps reassessing their positions in Apple, maybe due to valuation concerns, growth prospects, or simply portfolio reallocation.
Interesting dynamic. Okay, moving to the key technicals for Apple. Now, one source notes the current price around $200.85, but another has a lower figure, around $171.74. Let's try to focus on the $200.85 figure and the corresponding moving averages provided alongside it, just for consistency here.
Okay, sounds good. Looking at the moving averages associated with that $200 price. The 50-day SMA is cited around $225 or $204 depending on the specific source, and the 200-day SMA is around $225 in one source or $204 in another.
So critically, the price is...
The current price of $200.85 is below both of these key moving averages, whichever source you look at. That's generally interpreted as a sell signal and indicates a downtrend is likely in place.
And the death cross, was that mentioned for Apple too?
Yes, a death cross formation is explicitly noted here as well, just like the earlier mention for Nvidia, but here the price hasn't recovered above the moving averages. The 50-day MA has dropped below the 200-day MA, and the price is below both three. That's a classic bearish technical signal.
So a very different technical picture from Nvidia, which was trading above its key moving averages. What about momentum indicators like RSI and MACD for Apple? Do they confirm the bearishness?
They largely seem to. The 14-day RSI is noted at 36.3 in one source, which is getting close to oversold territory, usually below 30, but still technically neutral. However, another source suggests it is below 30, which is considered oversold.
Okay, so maybe some signs of being oversold, which could imply a bounce.
Potentially, but the other indicators are quite bearish. The MACD indicators are consistently negative, listed at negative 3.2 and negative 1.200 in sources. Other indicators provided paint a similar gloomy picture. CESTIO-CH, stochastics, is reportedly at 0, signaling extremely oversold conditions. CCI, Commodity Channel Index, is also oversold at negative 113.8. And the rate of change, ROC, at negative 15.2 indicates significant negative price momentum recently. Strong downward push.
A lot of red flags on the chart then. What are the key support and resistance levels the charts point to for Apple?
Support is identified down at $160. Resistance levels are cited up at $194 and then higher at $225.
So the overall chart insight for Apple based on these sources.
Based on these sources and the metrics they provide, the technical picture for Apple shows pretty significant bearish signals. The price is below key moving averages. You've got that death cross confirmation. Momentum indicators are mostly bearish. And while some metrics are in oversold territory, the overall trend appears clearly down based on this chart data.
Okay. Let's look at the price history and the drivers for Apple. Definitely a more mature growth story compared to Nvidia's explosive recent descent.
Yes, very different trajectory lately. The one-year total return for Apple is noted as just 5.87% as of May 2025 in one source. Another source actually has a slightly negative figure, around negative 0.15%, calling it unusually low and potentially just reflecting the specific calculation window or the impact of a recent pullback.
Yeah, night and day compared to Nvidia's returns over the same period.
Yeah.
What about the longer term, say the 5-year return?
The 5-year total return is listed at a much healthier 156.79% as of May 2025. And historically, over a 10-year horizon, Apple generally outperformed the S&P 500 and performed roughly in line with or maybe slightly above the NASDAQ 100 index. So it has delivered solid long-term returns, just not the hypergrowth we saw with Nvidia recently.
And the recent historical price action. The sources mentioned a falling trend channel.
That's correct. The trend lately has been one of slower growth or even consolidation compared to its previous strong runs. The price breaking below that support level around $194 back in March 2025 was noted as a potentially negative signal, possibly indicating further declines. One source even mentions a year-to-date decline of 22% in 2025, based on some social media commentary tracking bearish sentiment.
So the key takeaway on price history for Apple is what?
It's that while Apple has certainly delivered solid, market-beating returns over the long haul and built immense shareholder value, its recent performance clearly reflects a more mature growth phase, and it's currently facing significant headwinds that are quite visible in that bearish technical picture we just discussed.
Right. On to analyst forecasts and ratings for Apple then. What's the consensus view on Wall Street here? Still bullish like Nvidia, or more mixed?
It's still rated a buy overall, but definitely with more nuance and caution than we saw for Nvidia. Looking at the data from October 2024, the distribution was something like 16 strong buy ratings, 22 buy, 8 hold, 1 sell, and 0 strong sell.
Okay, so still positive overall, but a larger proportion in those buy and hold categories compared to Nvidia's heavy strong buy weighting.
Exactly. More tempered enthusiasm, perhaps. The price target from October 2024 had an average of $240, with a range spanning from $175 up to $280. As of May 2025, the highest analyst target mentioned is $300, and the lowest is down at $165. A pretty wide range.
That is a wide range. Any notable recent changes in analyst views highlighted? Upgrades or downgrades?
Morgan Stanley actually upgraded Apple to overweight back in September 2024. They specifically cited what they saw as underappreciated AI potential within the company as a reason.
Interesting. So some analysts are seeing AI as a potential catalyst for Apple too.
Yes, that seems to be a theme. On the other hand, Barclays maintained their equal weight rating but did raise their target slightly after earnings in August 2024. So some analysts are highlighting AI as a potential upside driver.
So summarizing the analyst view.
Analysts generally maintain a buy consensus, yeah. They still see upside potential, particularly maybe from services or that future AI integration. But that wide range of price targets really reflects the acknowledged risks and the current pressures the company is facing.
Okay, that makes sense. So looking ahead, again, the future predictions, what are the bull versus bear scenarios laid out for Apple?
In the bullish scenario, that high-end analyst price target of $300 is mentioned, which would represent over 52% potential upside from that $200.85 price level we discussed. Another, perhaps shorter-term bullish target of $180 is suggested, based on the idea that the stock's oversold RSI condition might trigger a technical rebound. That might relate to the lower $171.74 price reference from the other source, implying a bounce from those lower levels.
And the catalyst that the bills are banking on to get there. What needs to go right for Apple?
Continued, maybe even accelerating, growth in that high-margin services segment, potentially hitting 20% growth or more annually, successful integration of compelling AI features into their products, creating AI-enhanced devices that actually drive people to upgrade, a potential iPhone refresh cycle that sparks a super cycle, with a large number of users finally upgrading older phones, and continued expansion and market share gains in emerging markets.
Okay. Now, on the bearish side, what are the downside targets?
Bearish price targets include that $165 level, which is the lowest analyst target mentioned, representing over 16% potential downside from the $200.85 price. Another source suggests the price could fall below $160 based on the idea that the current downtrend seen in the charts might just continue.
And the primary risks driving that bearish outlook for Apple?
These are the key challenges we should probably detail now. They include Apple's significant exposure to the crucial China market, its vulnerability to tariffs and trade tensions, ongoing competitive pressures across all their product categories, especially smartphones, regulatory scrutiny, supply chain issues, and maybe even concerns about the pace of innovation.
Okay, let's detail those risks and challenges. Now, the external pressures Apple faces seem quite significant according to the sources. Competition sounds intense across pretty much everything they do.
It truly is. They face intense rivalry everywhere. You've got Samsung, Google, and increasingly Huawei in the absolutely crucial global smartphone market. You've got traditional PC makers challenging the Mac lineup. And in services, there's a whole slew of streaming and other rivals like Spotify and Netflix constantly chipping away.
And China is a particular hotspot for competition.
Yes, the sources specifically highlight that competition is particularly significant and getting more aggressive in the critical China market, which is a huge source of revenue for Apple.
Regulatory scrutiny also seems to be a growing challenge globally for them.
Correct. Antitrust investigations and legal challenges seem to be mounting worldwide. They often target Apple's control over its App Store policies, its payment systems, and broader allegations of anti-competitive practices. Plus, new data privacy regulations popping up in different regions also add compliance costs and potential risks if they misstep.
And supply chain dependence, especially on manufacturing in China, that remains a major vulnerability, doesn't it?
Absolutely. Their heavy reliance on global manufacturing, which is still particularly concentrated in China despite diversification efforts, makes them highly susceptible to geopolitical tensions like the US-China trade war and potential tariffs. Also, production disruptions like those we saw dramatically during the COVID pandemic lockdowns, and even just rising labor costs in those regions.
How could that impact the business?
Well, continued issues here could directly impact production levels, maybe lead to product shortages, and ultimately hurt revenue and the stock price. Sources also note this risk is kind of amplified by their use of custom components, which are often sourced from only one specific supplier. That can lead to capacity constraints if demand suddenly surges or if that single supplier faces its own problems.
Is there also concern about the pace of innovation at Apple? Are they keeping up?
Yes, sources note there's definite pressure on Apple to deliver truly breakthrough innovations, something beyond just incremental updates to existing products like the iPhone or Mac, in order to keep justifying their premium pricing and maintain strong growth momentum. A failure to launch successful new product categories, something fundamentally different like the iPhone was initially, is considered a key risk to their long-term growth story. Can they find the next big thing?
And market saturation coupled with economic sensitivity, how do those play in?
Well, the global smartphone market, which is still their core business by far, is definitely maturing. Growth now comes more from convincing existing users to upgrade and stealing market share from competitors, rather than capturing millions of brand new smartphone users. That's harder.
And the economy.
Potential economic downturns or recessions could certainly dampen demand for their high-priced premium electronics. People might delay upgrades. Macroeconomic factors like rising interest rates are also explicitly noted as risks that could affect consumer spending habits. And just like for Nvidia, geopolitical risk, particularly those US-China tensions, is repeatedly mentioned as impacting both Apple's manufacturing and its market access in China.
So a lot of overlapping macro risks for both companies there. Finally, let's touch on management sentiment for Apple. How is leadership viewed?
Management, including CEO Tim Cook and CFO Luca Maestri, is generally assessed in the sources as solid and well-respected. They get credit for operational excellence, incredible supply chain management over the years, and smart capital allocation strategies, like those huge share buybacks and growing dividends.
And what are they saying publicly?
Recent earnings calls indicate management remains confident in their strategic direction. They particularly emphasize the continued growth in their services segment and the future potential they see in AI integration across their products. Tim Cook is quoted from a Q3 2024 earnings call saying something like, "We see incredible opportunities at the intersection of AI and our products. Apple Intelligence features represent just the beginning." And Luca Maestri highlighted that services set another all-time revenue record, growing double digits for the fifth consecutive quarter. So they're pushing those narratives.
So management sounds confident in their strategy, but the market sentiment seems maybe a bit more cautious or negative recently.
That seems to be the key insight here, yeah. Despite management's confidence in their strategic pillars like services and upcoming AI features, those external market factors we discussed, things like the geopolitical pressures, maybe the perception of the pace of innovation compared to rivals, and the maturity of the smartphone market seem to be weighing on overall market sentiment right now. And that's reflected in the stock's recent year-to-date performance and some noted bearish options activity mentioned in the sources.
Okay, that brings us to synthesizing everything we've unpacked on both Nvidia and Apple. Quite a contrast in many ways.
Definitely. We've looked at Nvidia, the hyper-growth AI infrastructure leader, strong institutional backing, overwhelmingly bullish analyst forecast for the most part, but, and it's a big but, facing significant geopolitical, competitive, and valuation risks. Plus, some signs of short-term technical caution on the charts.
And then Apple, the established tech giant, incredibly stable in many ways with that powerful ecosystem and growing services business, also highlighting its leadership in environmental initiatives, but currently grappling with market maturity, intense competition, growing regulatory hurdles, supply chain dependence, pressure to deliver the next big innovation, and showing clear bearish technical signals, along with some potentially shifting institutional sentiment among key large players.
So what are some of the key threads connecting or differentiating them that stand out from these sources?
Well, a major similarity is that both companies are significantly impacted by those geopolitical risks tied to U.S.-China relations and potential supply chain disruptions. That's a huge factor for both.
Right. Unavoidable for global tech leaders today.
Both also clearly see AI integration as a major future catalyst, but they're approaching it from fundamentally different angles, aren't they?
Totally. NVIDIA is positioned as the essential infrastructure provider, basically building the foundation, the picks and shovels for the AI gold rush. Apple, on the other hand, is focused on integrating AI into its devices and services to enhance the user experience and maybe drive upgrades, different parts of the AI value chain.
And the core differences in their current situation.
They just represent very different risk-reward profiles and technical outlooks right now. NVIDIA is the high-growth, potentially higher volatility play directly tied to the AI boom's infrastructure build-out, with a strongly bullish consensus view despite significant visible risks.
While
Apple is the more mature, perhaps more stable giant, relying on the incredible strength of its ecosystem and that growing services revenue stream. But it's currently facing pretty significant external pressures and showing a clearly bearish technical picture, even though the overall analyst sentiment is still predominantly buy.
It really underscores how understanding these multiple layers, everything from the nuances of institutional trading moves and technical chart signals, to the core company fundamentals, the specific risks they each face, and what the future predictions look like helps build a much more informed, textured picture than you get just following headlines or simple financial metrics.
Absolutely.